You guys are almost there, almost through our entire investor course. This is a second to last video. Let's talk about exit strategies. So you've got the property, you went through the whole hero's journey, got that thing leased out, and it's making you money. Tyler, at what point in time do you look at your portfolio to know if you should sell off an asset or continue to hold it? Because we've talked about like the best way to get wealthy is to hold a thing forever. But when do you decide to sell?
I think if you want to keep things really simple, what would Dave Ramsey say? He would say, hold on that property, pay off the mortgage, and let it ride. Yeah. But mathematically, is that going to maximize your capital? Heck no. There's a metric out there called return on equity. If my equity in a property is worth X and my rent collected each year is X, what is the return? What is that number when I divide those two numbers? So let's give an example. Let's say I have a little bit of equity in a property. I have $30,000. I just bought it. Maybe that was my down payment. And all my rent collected is $5,000. Well, I would do $5,000 divided by $30,000 equals my return on equity. But let's say now, 20 years later, I have $200,000 of equity in that property. That's a lot of potential energy. That's a lot of capital. Capital is potential energy. And it's still only making me, let's say now it makes me $10,000 a year because rents went up, etc. Well, 10,000 divided by 200,000 is a much smaller number actually than my first return on equity. My return on equity went down even though the cash that's producing me each year went up because I have so much potential energy, so much capital in that property. So what I would tell that person is you need to sell and you need to buy 3 or 4 rentals with that potential energy because you could be making so much more wealth over time by using the equity in that property.
The other piece of that puzzle that I like to look at is, hey, why wouldn't I refinance? Well, I think that there's a simple answer to that. Underwrite the property today, right? We're talking about 20 years later, all this appreciation, the property's worth so much more, the rent's so much higher. Does it make sense and would you buy it as a rental today? 9 times out of 10, the answer is actually no, because the appreciation's exceeded the rent growth, which just happened to me on a property. You told me 17 times, sell, sell, sell. And I'm like, no, I want to hold it. And you're like, would you buy it today as a rental property? If you refinanced on that, would you buy it? I'm like, no, it'd make no freaking sense. It's just the equity position I'm in. You're like, okay, sell it, go buy 2. Why are you holding on to it? It's already served its purpose and ran its course. It's dead weight at this point, and it's soaking up all your potential energy. Every year, you should be looking at your entire portfolio and running this equation of how much potential energy do I have stored up in my portfolio to continue to deploy and buy more assets? There's no reason why if somebody's goal is financial freedom to have 17 properties paid off in full with all this cash flow. No, you probably could buy 100 properties in total and continue to build equity. It's all about the timing of the market, what's happening today. And I like the year pace of looking and just, quick back of envelope. Does it make sense to hold the 123 Main Street anymore? Or should I get rid of it? And then positioning, okay, cool. This year I'm going to sell 123 Main Street. I'm going to, get my agent in line and ask them what's the best month to sell and prepare that.
What would you say to someone that's like, cool, you've convinced me, Max. I should sell my property that I now own outright. I paid the whole mortgage off. It's worth $300,000. I'm going to sell it because that's potential energy I can use. Should I just sell it, pay the capital gains if there is one, and go on my way, put it in a bank account? Or is there another strategy that could work better?
Yeah, well, there's kind of twofold to that, right? If it's your primary, then probably just sell it. If we're just going to assume that it's in an LLC, you are 100% going to pay a crap ton of taxes on that equity that you made. And the way to evade that is to roll it over and redeploy. Number one, if our goal and our why is financial freedom, I don't want to see that $300K in equity hit somebody's bank account because that stuff will be gone immediately, right? It's never going to actually get redeployed into the asset because you're like, I won the lottery. I made all this money, right? How many people in the lottery still have all their lottery money? Not that many. You have to be wise. You have to be a rich dad and realize that using a 1031 exchange, which is essentially taking equity from one property and immediately investing it back into real estate within so many days. There's restrictions to how long you have to hold the property. What is it, like a year?
I think you have to, when you sell the property with a 1031 exchange, you have 45 days to identify what you're buying with the proceeds of the sale.
Yeah.
And then you have 180 days to close on that property.
Yeah. You just have to have it to where you're lining up an asset, making wise decisions and maneuvering that potential energy wisely.
It's tax deferred,
Yeah.
meaning that you will eventually pay capital gains,
Oh,
but on
100%.
one single property, not all the various properties you buy along the way. It's tax deferred exchange is what a 1031 exchange is.
Yeah.
And we highly recommend investors that are trading up, selling one property to buy two or three, use a 1031 exchange to defer capital gains.
In a market like Indianapolis, for us specifically right now, there's streets that you can buy a 200K home that, I mean, all signs point to in 4 years are going to be worth 400. And running that scheme of trading up and using the 1031, that's a whole sub market that investors are crushing at in Indy right now, making that, just really the goal is how fast can I own an 800K property outright just by buying a 200K. There'll be a video linked down. I've done quite the extensive research and math on actually how to win with that strategy. Never deployed it myself, but have talked to a lot of people that have. I think every time that you're going into a value add property, that whenever you're done with it, if the intent was to put a tenant in it and then refinance in 12 months and get your equity back, sometimes you get those things done and you really have to look at the current market and say, wait, should I exit out of this right now and just sell it as a flip? I've heard of a lot of people that are like, yeah, I was trying to do this cool Airbnb project that actually turned into a pretty sick flip because they went over and above and then looked at the market as a whole. They were never looking at it as a sale. They were looking at it as how much money can I get back in 12 months, refining. They weren't even worried about that. They were just fixing the place up to be an Airbnb. They're like, shoot, I got to exit out of this. And then they went and bought a cooler house and just turned it into an Airbnb and had a huge win. So always look at the exit, right? If you're on a plane, what are you doing? You're identifying where the exits are if this thing comes down. Same thing in real estate. Know where your exits are and know how to use them and get out.
To recap, always be running the numbers on how much equity, potential energy you have in a property and what that can make. And if you want to trade up in properties or buy more properties, use a 1031 exchange, consult with your investor-friendly agent on how to do that, and get more properties, build more wealth. That's why we're here.